Welcome to the channel. I'm James, and today we are looking at Zoom Video Communications Inc. ticker symbol ZM. They have just released their earnings, and we're going to be going through these numbers right now. Then, based on these numbers, I'm going to give my updated value of Zoom using discounted free cash flow model and the Buffett-Graham intrinsic value. Is this stock a buy or a sell in 2022? Then at the end of the video, we're going to be looking at some technical analysis to see if you're interested in that in more of the short term. But what has happened with Zoom? The market has reacted pretty poorly to Zoom's earnings, although it is bouncing back a little bit at $127, down 3% on the day. Pre-market closing, it was actually doing very well, up to 132, up 5.8% on the day. But since the earnings release, it is down. So if we look at here, you can actually see that they have beat earnings. EPS reported $1.29 compared to $1.07. So that's a 20% increase. And on the revenue, 1.071 billion compared to 1.054 billion, which is obviously a small increase nonetheless of 17 million, but still a surprise nonetheless. So let's have a look at some of the numbers here. We'll talk about the highlights, and then I'll go through the actual balance sheet and income statement and cash flow statement. But year number of customers contributing to more than $100,000 in trailing 12 months revenue, up approximately 66% year over year. The fourth quarter total revenue is 1,071 million, up 21% year over year. Full fiscal year revenue totals to, I don't know why they do millions, but anyway, 4 billion, up 55% over 1 year. Maybe 4,000 million sounds more than 4 billion, I don't know. I think the billion sounds bigger. Fourth quarter GAAP income operations, 251 million, down 2%. Full fiscal year GAAP income, 1 billion, up 61% year over year. And let's just get straight into it. Oh, I think they said they're going to repurchase some stock. Authorization up to 1 billion of Zoom's Class A stocks. That's good, because I am going to talk about the shares in a second, but I think this is still pretty interesting to see. So let's get straight into it. But first, can you give a like on the video? Helps me out, and comment your thoughts down below. Are you going to be buying Zoom? Well, hopefully I can give you a good answer after this video. So we've got the 3 months ended January 21 and 22 on the left-hand side, and we have the year ended January 31st on this side, 21 and 2022. So let's firstly have a look at revenue. Revenue in the quarter of the previous year was 882 million. That is up to over 1 billion. So that is on the up. Excellent to see. And on the entire year, a very similar story, but a much more successful one. 2.6 billion in 2021. That is up to over 4 billion in 2022. So revenue is still growing massively. Next, we're going to be looking at the profit, which is the net income. But how do we get profit? Well, we take away all the operating expenses and everything else. You can see operating expenses are up on the quarter, 615 million compared to 814. We'll just look at the year here. 1.8 billion to 3 billion. Sales and marketing has doubled. Everything else, well, R&D has about doubled, sales and marketing's doubled, and general admin is only up a small amount, 1.1 billion compared to 1.9. So sales and marketing is up quite a bit, but it seems that is working because they've almost doubled their revenue. And in fact, if we look at the profit, 260 million compared to 490 on the quarter, but on the year, profit has doubled. 671 million compared to 1.3. So they've managed to less than double their revenue, but being able to generate a lot more profit out of that by doubling their profit size. Excellent to see. Earnings per share down here, $4.64 on earnings. We are going to be talking about this in the end when we go through the Buffett-Graham intrinsic value model, because that is what it uses. But we'll be getting into that in a second. Shares outstanding. Unfortunately, they are issuing more shares, 283 million compared to 296. So luckily, they are buying back their shares. As they said, they're going to spend up to 1 billion buying back shares, which is good for investors. Why is that good? Well, if you have 1 share of a company and the company has 10 shares, you own 10% in that company. If they issue 10 more shares, there's now 20, you would own 5%. So it is diluting you as a shareholder, but it depends what that company can do with that raised capital. Can they generate more profit? Can they generate more revenue? And can they get the share price up? If they can, then I think investors will be pretty happy with the returns, and then they won't be bothered about them buying back their stock. But last thing we want to look at is the free cash flow. So we'll look at the cash flow statement. Free cash flow is cash from operating activities, which is this line here, minus CapEx, which is property as purchases and equipment. So what is the net cash flow? You can see, net cash On the year, it is up to 1.6 billion compared to 1.4, and the capex is relatively well, it's increased a little bit, 80 million to 132, so pretty flat. So about 1.5 million in free cash flow, and previously it was 1.4. So free cash flow is up. So let's get into the models. So we've calculated the future free cash flows. You can see we have 21 million in 18, 114, 1.3 billion in 2020, and then the end of 2021, 1.4 billion. So we've calculated the future free cash flows, and this gives us a fair value back to the company today. You can see that, well, the free cash flow ratio is about 50 and 100, so I don't think it's going to particularly like the stock, but let's have a look. Yeah, currently $68 a share, which is 42% overvalued at the minute. But let's have a look at these numbers, because you can see that revenue is increasing massively. Analysts are thinking about a 16 to 12% increase over the next few years, but you can see they've gone from about 46, 76, 35. So let's go a bit more bullish on the revenue estimates. Let's just say they can go up 35%. What would that then give us? Still overvalued, but $97 a share. And if we look at the average free cash flow to net income rate, it was originally about 200%, now is 100%. So if they were to be able to get to 200% again, this would have them generating a lot of free cash flow. Then it would be a buy, but I think that is a bit too bullish for me. So let's have a look at I think the net income margins are about the same as well. So even on these most bullish estimates based on discounted free cash flow, it's still $100 stock, which means it's overvalued at the minute. But Buffer Graham intrinsic value, this takes earnings per share and expected growth rate. Analysts are expecting 13.5% growth rate over the next 5 years. Earnings per share of $4.64. So what does that give us? Actually, surprisingly, has the stock at a buy, $165, which is a 40% discount. So discounted free cash flow model says it's not a buy, but the Buffer Graham intrinsic value says it is. So very interesting. It would have to be a lot more, generating a lot more free cash flow to be buy here, but this is easily a buy here. $165. If we go back to here, I mean, it was $165 not too long ago. The stock has been taking a beating, but down from its all-time highs at about 400. So if you thought it was a buy at 400, why isn't it a buy right now? Let's get into some of the technicals. We have a 50-day moving average in red, 100-day in yellow, and a 200-day in green. And I have said that backwards. Those numbers are the way around. 50 green, yellow 100, 200 red. And what are we seeing here? Well, the price is below all three major moving averages, and the averages are in the order that we do not want to see. Price is obviously on a massive downturn. So if you were to use this information when you would have sold the stock, really the big bearish signals you would have got were around about here at 370. You would have sold the stock there and avoided all this all the way. But now the stock is at 126, which is the lowest it's been this entire year. And in fact, if we go out before the massive boom in the COVID pandemic, it looks like it's pretty much at some levels that we haven't seen in a while. Here it is. This is a previous level of support, and it has broke below there. The next batch under here is $111 a share, and then below that again would be 100. So this stock, if it does fall a bit more, could go away to go, even though they have beat earnings. Let's just have a look at the other technicals I like to look at, which is the MACD and RSI. MACD, I imagine, will tell us a similar story, so I'm not going to go too into it. Yes, bearish on the MACD and signal lines. They are crossing, although they have crossed the opposite way, but they will be crossing back again because of this negative day if it does finish tomorrow down. And the MACD and signal line are way below the zeros, which is negative. Once again, if you were to use this information, when would it be in your selling signals? Well, if you were really lucky, you would have got out in July, and if you were even luckier, you would have got out here. And you probably could have got out at this point again. So MACD is not good. So let's have a look at RSI, because I think that'll be a bit more telling. We've got the relative strength index. This is on the daily, actually trending towards slightly on the oversold regions, but not massively. But if we go to the weeklies, let's see where this is in relation to where Zoom it is. And wow, yes, this is the lowest in terms of RSI it has ever been since its IPO in July of 19, or June, sorry. Even lower at the pandemic. Obviously, the stock had this massive run up, but then has been on a pretty tailwind. So personally, I wouldn't buy the stock, but it is interesting that the Buffer Graham intrinsic value does have it undervalued at the minute. A lot of people do like the stock, so hopefully I brought some good information today, guys. So thank you very much. Please give a like on the video if you enjoyed it, and I'll catch you guys next time.